250 crore rupees. Let that number just sort of sit in your mind for a second.
It is a massive, just mind-boggling number.
Right. I mean, that is the eye-watering penalty currently hanging over the head of any Indian bank for a single solitary data slip-up. So welcome to the deep dive.
Glad to be here.
Today, for you listening, we are taking a really close look at a fascinating presentation. It's from July 2026, put together by Navi and the Foundation of Data Protection Professionals in India, the FDPPI. It's titled Banking in the Era of DPDPA.
And this isn't just some minor regulatory update. We're going to decode how this new legislation is, fundamentally rewiring the entire Indian banking system from the inside out.
Yeah, rewiring is the perfect word.
Because it is a complete systemic rewrite. I mean, for decades, if a bank had a data breach, all eyes immediately turned to the IT department, right? The folks sitting at the head office.
The tech guys in the basement.
Exactly. The assumption was just that data security was this centralized technology problem.
Yeah.
But this new legal landscape, it completely takes that massive regulatory burden and decentralizes it.
Which means what, practically?
It basically turns every single local bank branch you walk into, like the one on your corner, into an autonomous, high-stakes digital compliance unit.
Which is wild to think about. To really grasp the scale of this shift, I think we need to look at the legal timeline from the sources. For a long time, digital banking in India operated under the Information Technology Act, the ITA, from way back in 2000.
Specifically Section 43A.
Yeah, Section 43A, which dealt with reasonable security practices. But we are looking at a hard deadline here. As of May 13th, 2027, Section 43A is being completely replaced by the fully operational Digital Personal Data Protection Act, the DPDPA of 2023.
Yeah, and remember, the DPDPA was passed back in 2023, but it was designed with a highly staggered rollout.
Because the infrastructure changes were just too huge.
Yeah. Oh, absolutely massive. We saw certain provisions kind of activate in 2025 and 2026, but May 2027 is the real watershed moment. That is when the transitional safety nets disappear and the full enforcement mechanisms just totally come online.
I was trying to conceptualize this shift, and the best analogy I could think of from the reading isn't just like upgrading a bank vault. It's more like transforming a bank's whole network into a hazardous materials supply chain.
That is a great way to put it.
Right, because under the old rules, the main focus was making sure the central warehouse, the head office, was locked down. But under the DPDPA, every single truck driver, every local handler, every branch manager needs a verified, isolated containment protocol.
They all become critical failure points.
Yes. And what's really interesting is how this interacts with the old laws. The old IT Act isn't actually entirely gone.
No, and that's a really crucial distinction. Section 43A is wiped out, sure, but Sections 43 and 72A of the old IT Act remain fully in force.
Wait, really?
Yes, which creates this deeply complex liability structure for the banks. They are suddenly fighting a war on two entirely different fronts.
Okay, so walk us through the mechanics of that dual liability. How does a bank actually get hit from both sides?
Well, under the old Section 43 of the IT Act, individual victims still possess the right to pursue civil litigation.
Like they can sue the bank directly?
Exactly. If your personal data is breached or misused, you can personally sue the bank for compensation based on whatever damages you suffered. That civil liability remains totally intact.
Wow. Okay, so that's the first front.
Right. But layered on top of that civil threat is the new regulatory hammer of the DPDPA. Now, the government, specifically the Data Protection Board, can step in and hit the bank with statutory fines completely independent of any individual lawsuit.
Which brings us back to those staggering numbers we started with. The breakdown in the presentation is just severe.
It's astronomical.
So if a bank fails to take reasonable security safeguards to prevent a breach, the board can levy a penalty of up to 250 crore rupees.
Just for failing to prevent it.
Right. And if a breach does happen and the bank fails to immediately notify both the board and the affected customers, that's another fine of up to 200 crore rupees.
It just stacks up.
And then there is this third tier, which is an additional 150 crore penalty specifically for entities classified as significant data fiduciaries.
And practically every major bank in the country falls into that exact category.
Because of the size.
Because of the sheer volume of data they process, the extreme sensitivity of financial records, and the systemic risk the institution poses to the wider economy. These fines are not designed to be a slap on the wrist.
Right. They aren't just a cost of doing business anymore.
No, they are designed to force data protection onto the agenda of every single corporate board meeting.
But practically speaking, how does the law enforce that level of accountability? Like, if the Data Protection Board actually issues a 250 crore fine, whose neck is literally on the line?
Well, what do most people think?
I mean, the common assumption is that there's a highly paid chief data protection officer, right? Someone sitting in a glass corner office in Mumbai who just absorbs all of this legal liability for the whole company.
That is what everyone assumes. But the DCPA completely dismantles that centralized model.
Mhm.
The legislation pivots entirely on this concept of the data fiduciary.
Okay, define that for us.
The law defines a data fiduciary as any person who determines the purpose and the means of processing personal data.
The purpose and the means.
Yes. So we have to ask ourselves, who is the person actually interacting with the customer? Who is collecting their identification documents, deciding why that specific data is needed for a specific local transaction, and actually entering it into the system?
Well, that would be the local branch manager.
The local branch manager. Under the strict interpretation of the DPDPA, that branch manager acts as the frontline data fiduciary.
Wait. So you're telling me a local branch manager who is busy dealing with cash deposits, angry customers, loan approvals, is now carrying the exact same legal burden as a tech CEO?
They absolutely are. They bear the legal responsibility for issuing the correct privacy notices right there in the moment, collecting valid and granular consent, and facilitating the new data rights of the customer.
The customer being what the law calls the data principal, right?
Exactly. So the branch manager is now responsible for facilitating a customer's right to access their data, their right to correct inaccuracies, their right to immediate erasure, and even their right to local grievance redressal.
Okay, I need to push back on this a bit, though. Let's look at the actual workflow of a branch. The branch manager doesn't write the software code. They don't design the customer relationship management platform, the CRM.
No, they don't.
Right. So if a manager is sitting at their desk and the corporate CRM software literally hard codes a mandatory field for a customer's tax ID before it lets them click next on a loan application, how can the local manager be held liable for that? It's a fair point. Because the head office IT team dictated the means of processing by building those software constraints. Shouldn't the liability roll up to the people who bought and built the software?
That is a very sharp observation, and it really cuts to the heart of why this transition is so difficult for banks. You are right that the head office dictates the broader technological infrastructure.
Yeah.
But the DPDPA evaluates the localized context of the data collection. The head office provides the tool, but the local branch manager makes the localized judgment call on the purpose.
I see.
When a customer walks in with a unique edge case problem that doesn't perfectly fit a drop-down menu, the manager has to decide how to handle it. Do they ask for extra documentation just to be safe?
Or do they take a photocopy of an ID and just leave it sitting on their desk?
Exactly. Do they make a phone call to verify a detail completely outside of the CRM? The moment the manager makes an active decision about handling a customer's information in that physical branch, they're determining the local means and purpose.
Okay, so the real friction is between the rigid software they are forced to use and the highly fluid human judgment calls they have to make on the floor every single day.
Precisely. The liability isn't just about who coded the database. It's about the downstream processing of that data in messy, real-world scenarios.
And bank managers aren't trained for this.
No, they have spent their entire careers trained to mitigate financial risk, not data privacy risk. And that friction leads to catastrophic everyday mistakes.
Which perfectly sets up the first real-world case study from the presentation. And I love this one because it illustrates this exact clash. It involves a totally standard transaction, clearing a check.
Oh, the check scenario. It perfectly demonstrates how standard operational procedures under the old paradigm are just explicit legal violations under the DPDPA now.
So here's the setup for you listening. A woman named Mrs. Ramya walks into a local bank branch. She presents a check for 45,000 rupees. The check was drawn by a customer of that specific bank, a Mr. Suresh.
Okay, a very common scenario.
Right. The bank manager looks at the transaction and, applying his standard financial risk training, he asks Ramya for her PAN card, her permanent tax identification number, and asks her the purpose of the 45,000 rupee payment.
Which used to be standard due diligence.
Exactly. But Ramya knows her rights under the new law. She refuses. She cites the DPDPA and says, "You do not need my permanent tax ID to clear a check that someone else wrote to me."
Which is an entirely correct assertion of her rights. She is enforcing the principle of data minimization.
Because they just don't need it.
Right. The bank only needs to verify the signature and the funds, of the check writer, Mr. Suresh. They do not need the recipient's comprehensive tax history to process a simple clearance.
But the manager is caught in that exact friction we just talked about. He wants to prevent fraud. He wants to do his due diligence.
He's trying to do his job.
Right. So he picks up the phone and calls his customer, Mr. Suresh, to verify the check. But Suresh doesn't answer the phone. His wife does.
And here is where it all goes wrong.
Yep. The manager, focused purely on clearing the financial transaction, asks Mrs. Suresh about Ramya and explicitly asks what the 45,000 rupee check to this woman was for.
And the moment he utters those words, he has committed a severe regulatory breach.
The immediate fallout is a total disaster. Mrs. Suresh gets suspicious. She tells the manager she has no idea who Ramya is, and she insists the bank demand Ramya's PAN card before clearing the funds.
So now he's getting pressure from the client's family.
Right. The manager goes back to Ramya, leverages his authority, and basically forces her to hand over the PAN card. Ramya complies, but she does it formally under protest.
But it's the long-term fallout that makes this a boardroom issue, not just a branch issue.
Exactly. 3 months later, Ramya files an official DPDPA breach complaint against the bank for unauthorized data collection and coercion.
Which is bad enough.
But the secondary consequence is even worse. Mr. Suresh contacts the bank furiously, claiming that the manager's unauthorized disclosure of his financial transaction to his wife triggered a massive family dispute.
Oh, wow.
That is now ending in a divorce. So the Data Protection Board issues a formal show cause notice to the bank for a massive financial penalty, and the head office is suddenly demanding answers from a branch manager who honestly thought he was just protecting the bank's money.
If we connect this to the bigger picture and break down the mechanics of the failure here, it comes down to a fundamental violation of purpose limitation.
Okay, unpack that.
The bank collected Mr. Suresh's transaction data for the specific purpose of executing a payment. Under the DPDPA, data collected for one specific purpose cannot be casually disclosed or repurposed.
Even to a spouse.
Especially to a spouse. Crucially, in the eyes of data privacy law, a spouse is a completely unauthorized third party. The manager applied an anti-money laundering mindset, which encourages really aggressive holistic verification to a situation governed by data minimization.
That cognitive dissonance is just brutal.
It is going to cost the banking sector billions in fines if they don't radically retrain their frontline staff. Every single human interaction is now a legal minefield.
But, it's not just human judgment calls over the phone that get banks in trouble. It's also the systemic, sneaky tricks built right into their apps and websites.
Oh, absolutely. The digital interfaces are arguably a bigger risk.
Right. The sources highlight this massive shift driven by the Reserve Bank of India, the RBI, working in tandem with the new privacy laws.
Yeah, in May 2026, the RBI issued a sweeping set of guidelines that essentially operationalized the DPDPA for the financial sector's digital interfaces. They targeted the fundamental user experience, the UX of banking apps.
For our listeners who work in tech or product design, the implications here are huge. We are talking about the death of the single pre-ticked checkbox.
It's completely gone.
Right, because for years, the standard architecture for onboarding a user was to present a massive wall of terms and conditions with a single Boolean flag at the bottom, a pre-ticked box that essentially said, I agree to everything.
Yeah, you click it once, and the bank gets carte blanche access to your data, your location, your contacts, and permission to cross-sell you partner products.
But that legacy architecture is now legally non-compliant. The RBI and the DPDPA mandate granular unbundled consent, and the default architectural setting must always be no.
Which is a massive paradigm shift.
It's like going to a restaurant and having to explicitly order every single ingredient you want, rather than the waiter secretly slipping a mandatory expensive dessert onto your bill at the end.
That is a perfect analogy. And think about the engineering nightmare of retrofitting that into legacy banking mainframes. You aren't just changing a line of HTML on the front end.
You have to restructure the back-end databases.
Exactly. Instead of storing a single agreed equals true value for a customer, the database now has to store and continuously verify a really complex, multidimensional matrix of individual permissions.
And it gets even more complicated because the RBI has explicitly banned specific UI designs, which they formally categorize as dark patterns.
Right. They targeted the psychological manipulation built into these apps. For instance, the complete prohibition of basket sneaking.
Basket sneaking is one of the most insidious ones. You apply for a credit card online, you go through 10 screens of financial disclosures, and right on the final screen before you click submit, The app's code automatically injects a premium travel insurance package into your application.
Hoping you were suffering from click fatigue and just won't notice the final monthly fee went up.
Exactly.
Well, the RBI guidelines classify that as a deceptive practice that invalidates any claim of freely given consent. They have also strictly banned something called confirm shaming.
Ah, the emotional manipulation tactic.
Right. A pop-up asks, would you like to purchase our premium life insurance to secure your family's future? And the UX designer has deliberately made the opt-out button say something awful like, no thanks, I prefer to leave my family at financial risk.
It leverages guilt to manufacture consent. It's so gross.
It's coercive.
Yeah.
And the regulations go beyond just UI text. They address core product structuring too, like force bundling.
What does that look like?
A bank is now prohibited from telling a customer, we will only approve this highly desirable home loan if you simultaneously agree to purchase property insurance specifically from our in-house joint venture partner.
Oh, wow. So they can't lock you in.
No, the customer must be given the unbundled right to source that insurance from any compliant third party.
So how does a regulatory body actually enforce UI and UX design? Do they just audit the apps and hand out fines?
The enforcement mechanism is actually much more aggressive than a simple audit. Product managers and UX designers are now directly tethered to the bank's regulatory compliance.
Meaning what?
If the RBI determines that a bank utilized a dark pattern to missell a product, say sneaking an insurance policy into a loan application, the bank doesn't just pay a fine. They're legally mandated to fully refund the customer, claw back any internal commissions paid to the sales team, and compensate the customer for any consequential financial losses.
That is massive.
And furthermore, banks are now required to engineer a mandatory 30-day feedback loop into their systems.
A 30-day feedback loop, how does that work operationally?
Within 30 days of a digital sale, the bank must proactively reach out to the customer through a completely separate, verifiable channel to confirm that the customer actually understood the granular terms of what they clicked on.
To prove the consent wasn't manufactured by a confusing UI?
Exactly. If the customer expresses confusion, the sale can be invalidated.
Okay, so the apps are now strictly governed by this granular, continuous consent matrix. But the sources highlight a scenario where the entire concept of ongoing consent just hits a brick wall.
Yeah, the edge cases.
Right. What happens when the user can no longer click a button? As in, what happens when a data principal passes away?
This is navigating the absolute bleeding edge of the DPDPA. It forces a direct collision between traditional inheritance law, corporate IT security policies, and the new concept of data privacy.
Let's look at the nomination conundrum case study from the presentation, because this is wild. A general manager of a bank unexpectedly passes away. Shortly after, his daughter, who lives in America, sends a legal demand to the bank's data protection officer.
Okay.
She is demanding the administrative password to her deceased father's official bank-issued corporate email account, as well as access to an encrypted, bank-operated HR WhatsApp group.
Now, the immediate question any IT admin is going to ask is why an external family member is demanding access to internal corporate communications.
Because the general manager, despite his seniority, systematically violated the bank's acceptable use policy. Over several years, he used his secure corporate email address to manage his entire personal life.
Oh, no.
Yeah. He corresponded with his personal stockbrokers, managed his family's real estate investments, and stored his personal tax documents on the bank's servers. He had even informally shared the password with his daughter prior to his death so they could manage the investments jointly.
Which, just to be clear, is a catastrophic failure of internal security protocols.
Absolutely. But this is where the legal tension of the DPDPA creates a massive headache. The new law introduces the right to nomination.
Right.
It essentially codifies that a data principal's digital personal data is a form of property, meaning you can treat your data like property and nominate an heir to inherit control over it upon your death. So, the daughter's legal argument is really straightforward. The DPDPA says my father's personal financial data is his property. I am the legally nominated heir to his property. Therefore, the bank must provide the password so I can access my inheritance. So shouldn't she get the password?
It is a compelling argument on the surface, but this raises an important question about the boundaries of personal data. The short answer is a firm no.
No password for her?
Right. She fundamentally misunderstands the boundary between the contents of the data and the container that holds it. From a compliance and legal standpoint, the bank's response must be an undeniable refusal to provide that password.
Because the email account itself belongs to the bank.
Exactly. The email domain, the server infrastructure, the inbox architecture, these are corporate assets governed strictly by the bank's internal IT policy, not by civil inheritance law. Handing over password control of a corporate node to an external unauthorized civilian is a massive cybersecurity breach.
No matter what's inside it.
Right. It is completely irrelevant how much personal data the deceased stubbornly intermingled with his work. The infrastructure itself simply cannot be inherited.
But the bank can't just delete the inbox and tell the grieving family their financial records are gone, right?
Yeah.
They would be sued into oblivion for destroying inherited property. So how do they fix this?
They have to execute a highly specialized forensic extraction. First, the bank formally politely refuses the password request, but they immediately freeze and archive the data to prevent any auto-deletion rules from destroying it.
Okay.
Second, they demand the daughter provide robust legal documentation, like a judicial order or a formalized heirship certificate. An email from America just isn't sufficient for identity verification under the DPDPA.
And then once the legal paperwork clears,
Then the bank assigns a designated senior data officer to manually audit the archive. This officer must carefully forensically extract only the specific personal financial correspondence.
wow, manually.
Yes, and crucially, they must rigorously redact or withhold any emails, attachments, or threads that contain the bank's proprietary information, internal HR discussions, or the personal data of other banking customers.
So the bank is literally forced to become a digital forensics lab just to untangle one executive's failure to separate his work and personal life.
Exactly. And the incident report generated from this process will highlight that the most severe compliance risks often originate at the senior management level, where executives just assume IT policies don't apply to them.
We've covered a massive amount of ground here. I mean, we have local branch managers making disastrous judgment calls over the phone. We have back-end databases requiring total restructuring to eliminate dark patterns. We have forensic extraction protocols for dead executives.
That's a lot.
The scale of operational chaos is just staggering. How on earth is a massive national bank with thousands of branches supposed to survive this regulatory environment?
Well, they cannot survive it using traditional centralized management structures. The sources outline a really specific operational survival strategy known as the DGPSI Bank Branch Framework.
The Data Governance and Protection Standard of India.
Correct. And the core philosophy of the DGPSI framework is radical decentralization. It acknowledges that compliance simply cannot be dictated from a glass office in Mumbai anymore. It has to be operationalized to the extreme edges of the network.
At the branch level.
Yes, the framework transforms every single branch into an autonomous micro-compliance unit.
What are the actual mechanics of that transformation, though?
It basically formalizes the liability we discussed earlier. Every branch manager is officially designated as a sub-DPO, a sub-data protection officer.
Right.
They are no longer just executing corporate policy, they are actively managing a localized data ecosystem. They are required to conduct a physical and digital inventory of all personal data entering their specific four walls.
So they have to map the flow of data themselves.
Yes, they have to tag how data flows through specific local departments like retail savings, foreign exchange, small business loans.
That is a ton of work.
It is. The branch must also maintain its own independent consent register, which is essentially a localized cryptographic ledger, proving they obtained granular consent for every single transaction processed in that building.
Wow.
And they must establish a localized grievance redressal system. If a customer exercises their right to correct inaccurate data, they shouldn't have to navigate a national call center. The local sub-DPO must have the authority and the tools to execute that data correction right on the spot.
So the framework redefines the bank not as one giant monolithic entity, but as an aggregated network of hundreds or thousands of individual compliant microfiduciaries.
Exactly.
It fundamentally changes what it means to operate a bank.
To summarize the sheer scale of this transformation for you listening, we are crossing a threshold where your personal data is now being guarded with the exact same threat of catastrophic financial penalties as the actual cash sitting in a bank vault.
Completely.
The era of loose data sharing, of casually verifying a check with a spouse, and of sneaky app design, that era in Indian banking is officially over.
And this legal shift leaves us with a truly profound evolution in how we must conceptualize our own identities in the digital age. I mean, the DPDPA's right to nomination formally codifies your digital footprint as your personal property,
It's no longer just a record of your actions, it is an actual asset you own.
an asset that you can formally pass down to your heirs, possessing the same legal standing as a house, a locker, or a gold ring. Which leaves us with a massive philosophical and economic question to consider.
What's that?
Well, if our digital footprints are now legally recognized, sovereign property that survives our death, how long until the broader economy shifts? How will this totally reshape the way we evaluate, inherit, and perhaps even legally trade and monetize our own digital identities in the open market in the future?
That is a fascinating trajectory to think about as these laws take full effect. Thank you for joining us on this deep dive. Keep questioning the systems you interact with. Look very closely at the architecture of the apps you use every day. And remember, your data is now the most highly regulated asset in the building. We'll catch you next time.